Welcome back. Yesterday, we spent a lot of time talking about the AI landlord who just approved a massive, brand new tower because the tenant demand is just that overwhelming. But today, that same landlord walked out to the mailbox and found two envelopes waiting.
And neither of them was a rent check. The first envelope was the construction invoice for that new tower, which was larger than the market had expected. The second envelope was a suddenly much bigger utility bill.
That is what the market had to digest today. The construction invoice arrived through the capital expenditure numbers in yesterday's mega-cap reports. The utility bill arrived through a sharp rise in crude oil.
Two distinct cash flow shocks hit the same building economics. Heavy AI infrastructure spending met $100 oil, and that combination coincided with a visible repricing across growth assets.
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research. Let us map out exactly what that repricing looked like across the major indices. The Nasdaq took the absolute brunt of the selling pressure, dropping 2.15% to close at 25,137.69.
The S&P 500 fell 1.21% to 7,408.30, while the Dow Jones Industrial Average closed down 0.97% at 51,711.65. The Russell 2000 was slightly more insulated from the mega-cap tech weakness, but still fell 0.67% to 2,940.16.
The VIX also rose 12.38% to close at 18.70. The most visible company-level moves came from the names that reported yesterday. Alphabet shares fell 6.89%, and Tesla dropped 14.52%.
Those are simply the facts of the close. One reasonable reading is that investors applied a much stricter near-term cash flow standard after both companies disclosed heavy investment requirements.
That pressure was not just an isolated U.S. phenomenon, though the severity certainly varied depending on the region. Over in Asia, the Nikkei fell roughly 2.4 to 2.5%, absorbing a lot of that same technology and semiconductor sentiment.
But interestingly, the Hang Seng actually gained 1.28%, closing at 25,210.81, and the Shanghai Composite edged up about 0.25% to roughly 3,877. In Europe, the picture looked much more like the U.S. The Stock 600 dropped 1.18%, the DAX fell 1.56%, and the FTSE 100 closed down 0.73%.
Looking at the evening crypto snapshot, which of course is not an official close, just where things stand right now, Bitcoin was trading around $64,800, down roughly 1.5% on the day.
Ether was hovering around $1,870, down roughly 3%. And Coinbase closed the regular equity session at 161.16, down 2.99%. That combination was consistent with the broader risk-off tone in growth assets.
But some capital did rotate rather than leave every part of the market. While the Nasdaq sold off, the defense ETF, ITA, gained 3.08%.
The industrials ETF, XLI, rose 1.73%, and healthcare, XLV, was up 1.26%. The tape favored sectors with more visible current demand or defensive cash flow characteristics.
Meanwhile, the capital leaving the market was highly concentrated in areas that require high multiples or discretionary spending. The consumer discretionary ETF, XLY, dropped 4.61%. Communications, XLC, fell 3.5%. In software, IGV was down 2.16%.
It gives us a useful picture of the day's market story. Software and consumer cyclicals were repriced lower, while defense and industrials held up better. That rotation fits the two physical world shocks we are discussing today, even if one session cannot establish a lasting regime.
Let us unpack that first major shock, the construction invoice. Alphabet reported Google Cloud revenue up 82% to about $24.8 billion, with a $514 billion cloud backlog. Those numbers provide strong evidence that tenant demand is real.
But then you look at the immediate cost of building for those incoming tenants. Alphabet's quarterly Capex was about $44.9 billion, which pulled their free cash flow down to a negative $5.9 billion. More importantly, they raised their 2026 Capex guidance to a massive range of $195 billion to $205 billion.
Tesla showed a remarkably similar cash dynamic. They reported $28.24 billion in revenue and delivered 480,126 vehicles, but operating margins sat at just 1.4%. Q2 Capex was nearly $5.8 billion, leaving quarterly free cash flow at a negative $1.092 billion, and their 2026 Capex guidance was pushed above $25 billion.
The two businesses are very different, but their cash flow tension rhymes. Both are spending rapidly to build future physical capacity, and in these quarters, the spending exceeded near-term free cash flow. The tape appeared to place much more weight on that gap.
But here's the fascinating part. If Alphabet and Tesla are writing multi-billion-dollar checks, companies elsewhere in the chain are receiving them. The market is increasingly sorting businesses by the direction and timing of cash flow.
Exactly. The hyperscalers are the ones spending the money, but the physical bottleneck suppliers are the ones collecting it. Look at Micron today, up 3.2%. GE Vernova gained 4.69%. Applied Materials rose 1.6%. All of this happening on a day the Nasdaq was down over 2%.
And we saw even more concrete evidence of this cash transfer today with Nvidia and Amkor. They officially announced a $1.5 billion multi-year advanced packaging and development agreement.
Right, and specifically, Nvidia is providing a prepayment to support expanded U.S. advanced packaging capacity in Arizona. Just to be clear, it is a capacity and prepayment agreement, not an equity investment. It strictly supports advanced packaging and test for next-generation AI infrastructure.
It clearly illustrates the broader dynamic. Cash can reach physical bottlenecks, the memory chips, power equipment, and advanced packaging facilities, well before the hyperscale companies funding the build realize the full return on investment. This brings us directly to the natural objection. I can hear people listening to this and asking if AI demand is this real and the cloud backlogs are this huge, why did Alphabet, Tesla, and the broader Nasdaq fall so hard today?
It is the crucial distinction between the market story and the operating facts inside the companies. Management teams are working on a multi-year timeline. They are securing land, power, and chips because demand commitments and backlogs are expanding.
One dominant market story, however, is about duration and liquidity. Negative free cash flow extends the wait before rent covers the construction loan, and investors have to decide what that delayed cash is worth today.
Chuckles. The market is an impatient discounting mechanism. It may believe in future AI productivity and still demand a larger risk premium when the near-term invoice grows.
Tenant demand is strong, the infrastructure build is real, and the cash flow trough is real too. The sell-off was consistent with investors reassessing the depth and length of that trough, not necessarily declaring that AI demand had disappeared. We saw more evidence of this immense physical build-out after the bell today with Intel's Q2 2026 report. They posted $16.1 billion in revenue, which is up 25% year over year, and non-GAAP EPS of 42 cents.
The segment numbers really show where the demand is sitting. Data center and AI revenue hit $6.3 billion, up 59%. Intel Foundry revenue was $5.8 billion, up 31%. And they generated a very solid $7.0 billion in cash from operations.
Management specifically noted on the release that AI is driving unprecedented compute demand across the industry. Because of that, Intel is meaningfully increasing its investment in equipment, clean room space, and advanced substrates. Again, it is another version of the construction invoice.
For the third quarter, they guided to revenue between $15.8 and $16.8 billion and non-GAAP EPS of 38 cents. The market seemed to digest the numbers quite well. Shares rose roughly 4% after hours after an initial larger jump. It is just another factual data point confirming the sheer scale of physical infrastructure spend.
We also got a very important look at incumbent software with SAP reporting after hours. They posted cloud revenue of 6.28 billion euros, up 22% or 24% in constant currency.
Their current cloud backlog is now 22.9 billion euros, up 27%. Total revenue came in at 9.88 billion euros, up 9%. And crucially, for today's theme of cash generation, their quarterly free cash flow was about 3.0 billion euros, up 27%.
They also maintained their full-year cloud revenue guide of 25.8 to 26.2 billion euros and a free cash flow guide of about 10 billion euros. They did reduce their non-IFRS operating profit guidance to reflect some acquisition dilution, keeping the overall report fairly balanced.
The US ADR initially rose about 1.8% after hours. SAP shows that established software can still compound cloud growth and generate current free cash flow, even while parts of the infrastructure layer remain in a heavy investment cycle.
Shifting to the physical materials side, Newmont reported Q2 adjusted EPS of $2.10. The number that stands out is its cash generation.
Absolutely. They reported $2.924 billion in operating cash flow and a record Q2 free cash flow of $2.205 billion. They produced 1.293 million attributable gold ounces and kept their full-year 5.3 million ounce production guidance fully intact.
Their all-in sustaining costs were $1,621 per ounce, compared with an average realized gold price of $4,414 an ounce. Management noted that higher diesel and other operating costs contributed to cost pressure during the quarter.
Gold fell about 2.3% during the session, while Newmont's reported quarter showed strong cash conversion. A mining company's quarterly economics do not move tick for tick with one day's bullion price.
You mentioned Newmont's diesel costs, which takes us to the second envelope the landlord opened today, the utility bill. The macro and commodity data changed the operating backdrop.
Brent crude settled around $100.70, up about 7% and above the $100 mark. WTI settled around $92.20 to 40 cents, up more than 6%.
And we got some key economic data in the middle of this. Initial claims came in at 187,000 versus about 211,000 expected, with the prior week revised to 209,000. Continuing claims hit 1.796 million. That 187,000 number marks the 2026 low, showing the labor market remains stubbornly tight.
Oil rising against a firm labor backdrop can change the inflation discussion. The U.S. 10-year yield rose about 5 basis points to roughly 4.7%. The dollar index, the DXY, gained 0.3% to 101.44, while gold fell about 2.3% to around $4,052.
Oil, the dollar, and long yields rising together is consistent with tighter financial conditions. Crude does not directly set every data center electricity contract, but a durable energy shock can raise transport, equipment, fuel, and financing costs across the broader build.
That is the second cash flow shock. When Capex is already consuming cash, higher economy-wide energy and financing costs can make the path to surplus free cash flow more demanding.
The main reported catalyst for the crude spike was simultaneous risk around two critical shipping choke points. Fresh Houthi attacks targeted two Saudi-linked oil tankers around the Bab el-Mandeb and Red Sea routes.
At the same time, disruption risk around the Strait of Hormuz remained active. Fresh U.S. escalation warnings and ongoing strikes added to supply risk pricing in crude.
We are not going to debate the politics of the region. The market mechanism is that threats to multiple energy routes can increase the premium buyers pay for uncertain delivery.
If the disruption persists, that premium can spread into freight and maritime insurance, and eventually into broader inflation expectations. The higher long yields today were consistent with that concern, though one session cannot establish the full pass-through.
Let us bring this back to our commercial building analogy, because today's Capex and oil shocks help explain how the market sorted these businesses.
If you are the data center landlord, your cloud and software revenue is your rent. The chips, the power equipment, the server racks, that is the concrete and steel. The Capex is the massive construction loan you take out to build it all.
And your utilization is the tenants actually moving in. But to keep the building running, you have other relentless carrying costs. You have depreciation, you have maintenance, you have financing costs, and crucially, you have the utility bill to keep the lights and the liquid cooling running.
Free cash flow is what remains after those bills are paid. The construction budget rose, and the economy-wide energy bill jumped at the same time.
The same AI demand that supports bottleneck suppliers, the companies selling the concrete and steel, can temporarily depress free cash flow for the hyperscaler landlords writing the checks. This also ties the old economy to the new one. The 2026 Energy Institute Statistical Review and related CSIS discussion describe an energy transition that is additive rather than a clean substitution.
Global demand is adding low-carbon supply, while fossil fuels remain material to the baseline. That means old oil choke points still matter even as the electricity system changes.
New constraints are being added on top: grid capacity, transformers, batteries, and critical mineral processing. China has substantial advantages in several of those electricity and processing chains.
So the old choke points of Hormuz and the Red Sea can threaten oil supply, while newer bottlenecks can delay data center power and equipment. Both can influence the cost and pace of AI deployment. One has not simply replaced the other.
You cannot run a frictionless digital future without massive amounts of physical power. And today, the physical world bluntly reminded the digital world exactly what that power costs. Looking ahead to tomorrow, Friday, July 24th, we get the S&P Global Flash Manufacturing and Services PMI at 9:45 Eastern. The manufacturing consensus is about 54.5, and services is expected around 51.5.
We also get new home sales at 10 o'clock Eastern, with consensus looking for about 610,000. But the real macroeconomic focus for the market will be oil duration. Does Brent hold above $100 long enough to materially shift broader inflation and long yields? Or is this a brief geopolitical spike?
That question sets the stage for next week. Microsoft and Meta report on July 29th, and Amazon follows on July 30th.
The central evidence everyone will be looking for is their Capex, their cloud and ad monetization, their depreciation schedules, and ultimately, their free cash flow. We know they are building the towers. The market wants to see if the rent checks can keep up.
Which leads us to the open question for this entire cycle. Can the revenue and backlog growth actually outrun this immense Capex intensity and these rising energy costs?
The named tells include hyperscaler operating margins, Capex intensity, depreciation, and free cash flow. Next week's reports will also show how much cash is reaching suppliers versus remaining with the platform owners.
This is a likelihood game. No one can predict the future. Just one read of what the setup looks like today. The data changes, and the probabilities shift with it.
And one general principle remains: a correct long-term thesis can still produce a poor outcome if leverage or position size cannot survive the volatility along the way. Being right about the destination is not enough if the structure cannot endure the path.
Until next time, take care and keep following the money.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.